Hi everyone, let's talk for a minute about home affordability, specifically with regard to using the front end and back end ratio for finding out whether you can afford a house. Here we're going to take the example of Susan. Susan has a gross annual income of $54,000, and we're going to do a simplified budget for her. Monthly, that would bring in a gross of about $4,500, but let's say after taxes and health insurance and saving in her 401k, let's say her net income per month is $3,150. From there, we have some student loans to pay off, $500 a month. Credit card payment, some credit card debt we're trying to get rid of, about $300 a month. A car payment of $300 a month. And then looking at other expenses, she's currently renting an apartment for $700 a month. Pays about $300 in utilities every month. Groceries of $400. Clothes about $200 a month. And then general entertainment expenses $300 a month. That gets our total expenses to $3,000. Subtracting that out of net income, that's going to leave Susan with a surplus of about $150 a month. That's not a whole lot. It's cutting it pretty tight, but she's making do. So now let's bring in some other information here. And let's say Susan really has her eye on buying this house that costs $150,000. We're also going to assume she doesn't have any money for a down payment, so she's going to have to finance the whole thing. Some first-time home buyer loan programs will allow you to do this. So let's start looking at how much we think this house is going to actually cost, and then look at the ratios to determine whether we think she'll be able to get a loan. So in order to determine what the principal and interest are going to be, we're going to use the Excel function payment. If you don't know how this works, I'll create another video, but basically we're going to say the interest rate monthly is going to be 5% divided by 12 because there's 12 months in a year. The number of periods is going to be 30 times 12. 30 years times 12 months each year. The present value we're going to put in as negative 150,000. The negative is so it'll give us a positive number at the end. What we'd like is for the future value to be 0, and we won't worry about the type for right now. So principal and interest monthly on that 150,000 is going to be $805.23. From there, if anybody has a mortgage payment, you know that principal and interest is not the only thing in there. We're going to have to pay property taxes. Let's assume that's about $130 a month. Usually that's rolled into the mortgage payment. Oftentimes your insurance can be as well. Let's just make an assumption about $100 a month. Since we didn't put a down payment, we're probably going to have to pay private mortgage insurance or PMI, and let's assume that's about $100 too. So to determine what the actual monthly cost of that house is going to be, we're just going to add all these up. So total housing expenses if she bought this house, $1,135.23. So she's going to have to go to a bank and get approved for a loan. And when you go to do that, there are multiple ways that banks will try to figure out whether they can loan you that money. Credit score is going to factor in. But this video, we're concerned mostly with using these ratios, debt to income ratios. There are a couple that we talk about in the book. The one is front end ratio. The other one is the back end ratio. To find the front end ratio, what you do is take the total housing expenses, you divide that by gross income, and most banks are going to set the front end ratio limit at 28%. So as long as your total housing expenses aren't more than 28% of your gross income, you're okay. A much more common one for banks to use, and I think the better one, is the back end ratio, where you take not only your total housing expenses but also other debt expenses that you have. You divide that by your gross income to find the back end ratio. So, and most banks are going to have a limit of 36% for the back-end ratio in order to approve you for a loan. So, given those percentages, let's just try to find out what would technically be affordable according to those percentage limits. So, if we brought it right up to the 28% front-end ratio limit, the amount that she could afford to pay per month would be the gross income per month multiplied by that front end limit. So $1,260 a month. Looking at that, so the affordable payment would be $1,260 a month. Her total housing expenses would be $1,135 a month. So it looks like she's going to come in right under that limit to be able to afford that. But like I said, the back-end ratio is much more common for banks to use because I think it gives a much more clear picture of whether somebody can actually afford a house. So the affordable payment for using the back-end ratio is going to be that $4,500 multiplied by 36%. It's going to give us $1,620. It looks like that makes the house more affordable, but what we have to consider is that we have to subtract out because it includes all debt payments. We have to subtract out those debt payments to see what the total housing expenses would be that she can afford. So total debt payment is going to be $1,100 a month. So let's say 1,620 minus the $1,100 a month for the other debt expenses. So this gives us a much different picture of what we think would actually be affordable for Susan. If we use the back-end ratio here, she really can only afford to spend about $520 a month on housing to qualify under that 36% back-end ratio. The reason why this is just she's got a lot of debt that she's paying every month. So ways you can improve that back-end ratio are to get a lower car payment, pay off those credit cards, pay off those student loans, and then it becomes much easier to afford and get qualified for a loan. So let's do the rest of the math just to see how everything works out here. Let's assume that she's going to try to buy that $150,000 house. The example front-end ratio here would be, since front-end ratio, we take total housing expenses divided by gross income. So total housing expenses here of $1,135.23. We're going to divide that by gross monthly income. That would put her front-end ratio at 25%, which is less than the 28 limit, which would have her in okay shape. However, let's look at back-end ratio. Let's say total housing expenses of $1,135, but we also have to add in the other debt payments. So student loan payment of $500. You have to add in the credit card payment, add in the car payment. Then we divide that by gross income. So we have a problem now. As we saw earlier, that's going to put her back-end ratio at 50%, which is considered pretty high. It's going to be hard to get a loan with a back-end ratio that high, and even more importantly than just getting a loan, it would probably just be a bad idea because that's going to make it very hard for her to afford to live. So if we assume that she would be not paying rent anymore and we just plug in total housing expenses, for instance, let's see how that would affect her budget. So yeah, like we thought, the problem here is going to be that making that $1,135.23 housing expense every month, that's going to put her in the negative every month. So ways that I can get around this, like I said, pay off this debt. We can also buy a cheaper house. If family is willing to give some money to put a down payment to reduce the actual money, that part of the house that I finance, that can bring down that total cost of housing expenses. So using a cheaper house, putting down a big down payment, that would also have the benefit of reducing or eliminating PMI probably, ways that we can try to find ways to afford this house. But it looks like for right now, it's probably not a good idea for Susan to buy this house.